Less than break time equals 3 seconds / greater than. Are you still chasing local bank dividends because they feel safe? It is worth considering whether that exposure represents a classic late-stage retirement risk. As global central banks ease, those record-breaking net interest margins are preparing to compress. If your retirement drawdowns are heavily exposed to local financial counters, your income stream could face unexpected pressure. But look at the data over here. While the retail herd focuses on short-term macro headlines, a quiet industrial giant is flashing a 5.93% dividend yield backed by a massive $2.63 billion net cash bunker. This isn't about chasing market hype. It is about evaluating a balance sheet that may act as a structural firewall when the credit cycle peaks. Let's read the balance sheet plumbing and analyze the financial gates to see if this industrial counter earns a spot on your conservative income watch list. Chasing bank yields when credit cycles peak is a classic late-stage retirement mistake. While local bank net interest margins begin to feel the squeeze from global interest rate easing, Yangzijiang Shipbuilding is flashing a 5.93% dividend yield backed by a colossal $22.3 billion order backlog and a 2.63 billion Singapore dollar net cash bunker. If your retirement drawdowns are heavily exposed to local financial counters, this industrial giant isn't just an alternative, it is a structural firewall against capital erosion. When you look at this industrial counter, you are seeing a 5.93% dividend yield backed by record corporate earnings. This isn't just a short-term spike, we are talking about multi-year revenue that is locked in all the way to 2030. On top of that, they are holding a massive net cash bunker of 2.63 billion Singapore dollars, which means they have absolutely zero refinancing risk. Turning to the macro picture, this setup changes the game entirely for income investors. Listen to your uncle here. If you are chasing hyper-volatile tech growth or scraping for short-term trading momentum to flip a fast buck, close this tab right now. This piece isn't for you. Go back to your forums and hunt for memes. This is for conservative retail investors who are actively building, protecting, or living off an income portfolio. Our primary mandate is absolute capital preservation and predictable annual distributions. The recent market correction has pushed this industrial counter straight into our forensic crosshairs. When the general retail public panics over short-term macroeconomic headlines, the institutional money quietly looks at the fundamentals. A strengthening balance sheet during a global trade and geopolitical crisis demands a deep investigation. We look directly at the forensic footnotes to reveal what mainstream headlines skip entirely. Let's step into our first major section and run the financial health check. This is an industrial balance sheet that has been fundamentally re-engineered to perform like an absolute fortress. Look at the numbers on screen. Revenue came in at 28.50 billion renminbi, up 7.4% year-on-year. Net profit surged 30.2% to 8.64 billion renminbi. Gearing sits at a low 15% against our 35% house ceiling, while interest coverage obliterates our floor at 77.3 times. Net debt to EBITDA is negative 1.52 times, and dividend per share stands at 20 cents, a clean 66.67% jump. Every single hard financial gate delivers a perfect pass. Now look closer at the plumbing. A standard desktop screener will flag that Yangzijiang's reported free cash flow declined by 78.9% year-on-year, coming in at 2,511.6 million renminbi. The uneducated retail herd sees this, panics, and hits the sell button. But the decline was entirely driven by a deliberate strategic 1.95 billion renminbi CapEx outlay used to fund the Poseidon Corporation acquisition. If you look at the underlying operational cash, it sits at a robust 4,464.6 million renminbi. The core cash engine remains completely intact. To understand how I rate the market, let's review the forensic zone system. These are reject first, think later structural filters inside my second brain, designed to remove human emotion from capital allocation. Zone 1 is our fortress sanctuary with high yields, low gearing, and zero flags. Zone 2 is our watch list, which passes all hard gates but carries minor valuation premiums. Zone 3 is conditional with recoverable flaws. Zone 4 is caution, failing at least one non-negotiable gate, and Zone 5 is the red zone, representing structural red flags that you must avoid completely. Turning to our second major section, let's run the wealth audit on yield and cash flow. The current dividend yield stands at 5.93% based on a share price of $3.47. To understand why this matters, you must understand exactly where your alternative risk-free sanctuary sits right now. The Central Provident Fund Special Account pays a guaranteed 4.0% floor in the second quarter of 26. It features zero company risk and zero price volatility. To leave that safety and enter the open market, you must demand a justifiable premium. This 193 basis point risk premium is the minimum defensive buffer for your capital. We take the 5.93% Yangzijiang yield, subtract the 4.0% government floor, and we are left with a clear net premium of plus 193 basis points. For every dollar of personal capital sitting outside the safety of the government system, this premium represents your protection. Yangzijiang clears this hurdle cleanly. When we establish our stress test buffer, our house framework maintains a strict conservative forensic floor of 3.2%, anchored to long-term historical averages rather than temporary market cycles. Look at the short-term rates. The latest Singapore 6-month T-bill auction on 4 June 26 delivered a sharp cutoff yield of 1.48%. Short-term rates have fallen significantly, but our forensic standards do not follow them down. Our minimum acceptable yield hurdle is calculated as the 3.2% forensic floor plus a mandatory 150 basis point risk premium, setting our absolute line in the sand at 4.7%. Yangzijiang outpaces this hurdle with a wide margin of safety of plus 123 basis points. And here is the part that matters. The dividend payout ratio stands at a pristine 50%. The company is distributing half of its record net profit to retail shareholders in cash, while retaining the other half inside the business to fund yard expansion. When it comes to servicing its debt obligations, the company's metrics are exceptional. For every single dollar of interest Yangzijiang owes, it generates $77 in operating income. An interest coverage ratio of 77.3 times completely obliterates our 4.0 times house floor. This represents one of the strongest defensive liquidity cushions in the entire industrial sector. Yangzijiang has successfully detached itself from the traditional, capital-starved shipbuilding cycles that routinely wipe out lesser marine engineering firms. Management recently trimmed their 26-order win target down to $4.5 billion, a deliberate 25% reduction from their original guidance. The mainstream financial press labeled this a slowdown. That is a fundamentally lazy assessment. This was strict slot discipline, prioritizing high-margin, clean energy vessels over empty, low-cost volume. More importantly, look at the alignment of interests. Executive Chairman Ren Letian directed Heng Yuan Asset Investment Limited, his personal private vehicle, to acquire a parallel 5.0% stake in Poseidon Corp at the exact same moment Yangzijiang executed its own 10% corporate position. That means the chairman's personal family wallet is locked into the exact same room as you, the retail shareholder. This precise structural alignment prevents the casual cash-burning executive decisions that typically destroy operations during global trade downturns. Skin in the game is the ultimate balance sheet signal. Stepping into our third section, let's run the price check on valuation. The stock has experienced a 21.5% pullback from its 52-week high of $4.42, reached back in March 26. For a forensic income investor, a drawdown of this scale on an entirely clean balance sheet demands an immediate deep investigation, not an emotional reaction. Short-term market noise does not alter the underlying operational cash generation by a single cent. Let's run a high-signal peer calibration against its direct listed rival, Seatrium. At a share price of $3.47, Yangzijiang trades at a trailing PE of 8.45 times and a PB of 2.25 times, while offering a 5.93% dividend yield and holding 15% gearing as a core dividend compounder. Contrast that with Seatrium at $1.96, trading at a steep 20.63 times PE with a lower 0.97 PB, but offering just a 1.52% yield with 42.9% gearing as a complex operational turnaround. Let's look straight at the elephant in the room. Yangzijiang's current P/B ratio of 2.25 times sits materially above its long-term 5-year historical median of 1.71 times. Under the strict guidelines of our forensic zone system, this valuation soft flag automatically clamps the stock's current designation at Zone 2 Watchlist. A clean pass on every single hard financial gate is locked in, but the premium over historical book value is real and must be acknowledged. The core analytical question you must ask yourself is this: does a record-breaking $22.3 billion order backlog that locks in clear revenue visibility straight through to 2030, paired with an unshakable net cash cushion of 14.4 billion renminbi, justify paying above historical book value? That is a calculated judgment call you must make with your own capital. The forensic framework is designed to illuminate the risk. It does not replace your brain. Independent discounted cash flow models calculate the mid-case conservative fair value of Yangzijiang at $5.51 as of 11 June 26. This implies that even with the historical P/B premium, the current share price of $3.47 sits at an attractive 37% valuation gap to its long-term intrinsic earning capacity. Retail panic over temporary trade disruptions has created your structural entry point. Break time 0.5 seconds. Contrast this industrial yield profile directly against the local Singapore banking heavyweights like DBS, OCBC, and UOB. The big three banks printed record profits on the back of historic high interest rates. But as global central banks continue to ease, local net interest margins are peaking and preparing to compress. Chasing cyclical bank dividends at the absolute peak of a credit cycle is a textbook late-stage structural error. True diversification means intentionally reallocating capital away from financial counters vulnerable to rate cuts and steering it toward industrial infrastructure providers that collect non-discretionary global trade tolls. Whether the central bank eases or tightens, global commerce requires physical ships. Let's step into our fourth section and analyze the dividend trajectory. We never buy a dividend history based on a single year of performance. We demand a multi-year, mathematically verifiable progression. Look at the clear step up in dividends per share over the last 3 financial years, moving from 6.5 cents to 12 cents and now sitting firmly at 20 cents. This data reveals an uncommonly clean structural growth story. Let's break down this structural progression row by row. In financial year 23, the company delivered 6.5 cents dividend per share on a 34% payout ratio. In financial year 24, that stepped up to 12 cents on a 38% payout ratio, representing an 84.6% jump year on year. Now for financial year 25, we see 20 cents dividend per share on a 50% payout ratio, a 66.7% increase. Crucially, this distribution is comprised entirely of ordinary cash dividends, with zero unstable one-time special components hidden inside the payout. The payout ratio expanded safely from 34% to 50% over a 36-month window, funded entirely by genuine, unmanipulated net profit expansion, which grew by 30.2% in financial year 25 alone. The distribution check hitting your bank account is rising because the underlying corporate earnings are rising. That is the definitive mechanical difference between a compounding asset and a dangerous yield trap. And here is the part that matters. Because the payout is capped at 50%, the remaining half of record profit stays inside the corporate vault, maintaining a substantial capital headroom and a fortress balance sheet without stretching credit lines. Turning to our fifth section, let's run the forward stress test. Most financial newsletters paint a purely optimistic picture because they want your subscription clicks. They assume global trade runs flawlessly forever. We do not operate that way. We stress test for the worst-case scenario to see if our income floor collapses when the macro climate freezes over. We actively audit for the catastrophic storm, not for the beautifully sunny day. Let's deliberately engineer a severe ice storm forward scenario for Yangzijiang's next financial cycle. We assume severe geopolitical blockades across key maritime straits cause global shipping volumes to contract sharply. Next, supply chain freezes create severe delays in steel deliveries to the yards. This results in core operating net profits compressing by a brutal 20% across the board, while management holds its dividend payout ratio strictly anchored at 50% to preserve cash. Let's run the exact mechanical distribution math under this stress test scenario. A 20% profit contraction reduces our compressed earnings per share estimate down to 32 cents. Multiplying this by our 50% payout ratio gives us a stress-tested dividend per share of 16 cents. At a share price of $3.47, this compressed payout still lands at a stressed yield of 4.61%. Recall our non-negotiable house hurdle of 4-point logic 7%. Under a severe contraction, Yangzijiang lands a mere 9 basis points below our ideal baseline while completely crushing the 1.48% risk-free T-bill rate. This is real balance sheet resilience. Let's step into our sixth section and deliver the intuitive retirement verdict. For the accumulation phase from age 25 to 45, it is a clear pass, as reinvesting a sustainable 5.9% yield provides powerful compounding over time. For the transition phase from 46 to 60, it is a pass, providing an exceptional capital reallocation sanctuary away from peaking banking counters. For the drawdown phase at age 60 and above, it is a pass, offering rock-solid cash flow visibility through 2030. Our final forensic zone assignment is locked at Zone 2, Watchlist, clamped strictly due to the historical P/B premium, despite a clean pass on every single hard financial gate. Let's contextualize this through a human lens and look at a real-world case study. Consider a 58-year-old retail investor named Beng, living in a 4-room HDB flat in Bidok. Beng is actively preparing to transition his supplemental retirement scheme account away from aggressive growth assets and into a highly dependable, low-friction annual drawdown structure to secure his golden years. If Beng reallocates $100,000 of his capital into Yangzijiang at the current entry level, his portfolio shifts into gear to generate approximately $5,930 in annual cash dividends. Compare this to leaving that same capital inside the CPF special account alternative at a 4% guaranteed rate, which yields $4,000. That represents an extra annual heartland cash flow of $1,930 streaming directly into Bank's pocket to fund his retirement lifestyle. Why does an unstable interest rate environment fail to threaten this specific corporate income stream? Because unlike highly geared REIT-style structures, Yangzijiang does not carry billions in expensive, floating-rate commercial bank debt, meaning there is no looming refinancing wall. They sit on a massive net cash mountain of 2.63 billion Singapore dollars. Bank's income floor is thoroughly insulated by physical steel and secured freight contracts. The general retail public is trapped in a perpetual loop. They chase high headline yields right before a structural distribution cut forces the stock price to tank. They lose their retirement capital because they refuse to read the balance sheet plumbing. Elite investors do things differently. They read the forensic footnotes first to secure their defensive buffer before deploying a single dollar of capital. The window is already open. For just 9 Singapore dollars a month, you can upgrade to elite investor status and break through the retail information embargo. You get 0-day access, letting you read every single deep dive forensic balance sheet audit a full 7 days before public release, allowing you to position your capital before the market reacts. You get the full red zone watch list with instant alerts on structural risks, unsustainable distributions, and interest coverage breaches. Plus, you get clean, unmanipulated institutional cheat sheets directly from My Second Brain to keep your retirement capital parked safely inside the sanctuary zone. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. Stocks assessed under Iggy's forensic yield standard are benchmarked against the 4.7% minimum yield hurdle. Stocks flagged as growth watch fall below this threshold but demonstrate clean balance sheet metrics and an identifiable growth catalyst. These carry a materially different risk profile and are not suitable as yield replacements for income-dependent investors. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.